We're heading into another busy earnings week. Last week, Toronto-based Aecon, the engineering company, reported its highest ever quarterly revenue, a record project backlog, and a foray into U.S. nuclear projects. Let's get more from Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management. Rebecca, great to see you, and thanks very much for joining us.
Thanks for having me.
Do you think ARE is a buy right now?
Yes, it's interesting. It was my top pick last time I was on Market Call, but I think the stock was probably, I think, $7 cheaper than what it is now. It's definitely had a run. You could see that just in the past week alone. There's been several announcements with regards to some nuclear deals, particularly in the US, that's caused the stock to move higher. The interesting thing is, if you followed the name for as long as we have, I mean, nothing that they announced is new, nothing is concrete. This is really just they've been doing everything that they say they've been doing. Like, they are working on nuclear projects in Canada. They have their hands on every single nuclear project, whether it's refurbishments or they have the deal with Darlington's first SMR, small modular reactor, that they're working on in Canada. And, now they announced last week that there's a partnership in the US to build one of the first small modular reactors in Washington state, and the stock was up 12% on that announcement. There's nothing really concrete there. Like, we don't have the finances, the numbers, the timeline. It's presumably going to be in past 2030. But I think the stock just ran with the idea that this is their first entry point into the United States. They have this technological capability for nuclear in Canada that they now can export into the United States, and investors are really happy about it. We like the name over the long term. I think the name got a little bit carried away. I think it was like the stock came off, 4% on Friday after, a really crazy week of the stock outperforming. So I could understand why some analysts have downgraded the name on a short-term basis. On a long-term basis, we're still happy to own it. I do think it'll probably come down a little bit from here, but I think there's really exciting things ahead for Aecon as it relates to, this nuclear renaissance and the need for, electricity and power demand.
Yeah, it's interesting. There were a couple of downgrades of Aecon last week, as I'm sure you know, after the stratospheric run. But it's such an interesting name. What about Berkshire Hathaway? Massive cash pile, not far short of $400 billion US right now.
Yeah, so you kind of just talked about it before the break, that massive cash pile. It's higher than it's ever been in history. Again, in the quarter, they were a net seller of stocks, not a net buyer. Similar to us, Berkshire, they buy names for the longer term. So the companies that they own are really good quality long-term names. So nothing wrong with the companies that they're owning, but what is wrong is the valuation. So if they're buying more, if they're selling more stock than they're buying, that's probably a sign that they feel like the underlying stocks in their portfolio are probably overvalued. We feel the same way about a lot of the stocks that we own in our portfolio. Like, we haven't been adding to many of our new names. We haven't really been selling them either because we are happy to collect the dividend, but it's been difficult to deploy new cash, which is also why Berkshire Hathaway is stockpiling, is piling up their cash. The other interesting thing, and I think this is probably why the stock is down, is that they haven't bought back any shares. And again, companies buy back shares when they think that their share price is undervalued. I think probably they're signaling that markets in general are very expensive, and Berkshire Hathaway is probably reasonably valued. So, they're not buying back shares right now in a market that is dealing with all-time highs on a day-to-day basis in a weakening economy. So there's really, I understand why they're not buying back shares right now.
We're awaiting Canadian natural resources numbers this week. The yield on the stock, 5.2%. It's still up, even though it's been a miserable in 2025, even though it's been a miserable year for oil prices.
But that's the beauty about a company like Canadian Natural Resources. Their decline rate is so low, their reserves are so high, and they're so profitable, even in a weakening oil price environment. This just is a testament to how premium their assets are, how strong the management team is. They're in the news today because they just completed a well-announced asset swap with Shell. So now they own 100% of the Athabasca oil mines project, and as a result, their production is going to go up. Their guidance has gone up slightly, but I mean, regardless of what's going on in the short term, this is our absolute favorite name to own in the oil space. Again, you're getting paid, I mean, 5.2%, but I think last week it was, almost 5.5%. The stock has had a move up recently, and as you said, in a declining oil price environment. But this is a name that you want to own for the long term. And if I'm getting paid, over 5% to wait, for and a company that continues to give back to its shareholders, whether it's through share buybacks or increased dividends. I mean, it has a stellar track record, strong management team, and premium assets. What's not to like about CNQ?
Rebecca, thank you very much indeed. Really appreciate it. Rebecca Teltscher,
Thank you so much.
portfolio manager at Newhaven Asset Management.